The Chinese Ministry of Commerce issued a notice last week that received almost no coverage in Western media. Starting January 1st, 2026, companies seeking to export silver from China must obtain government licenses. The application process requires proof of 80 tons minimum annual production capacity and $30 million in credit lines. Most silver exporters cannot meet these thresholds. China controls 60 to 70% of global silver refining capacity. This administrative change effectively removes the majority of global silver supply from international markets. The timing suggests coordination rather than coincidence. China's domestic solar manufacturing consumed 106 million ounces of silver in 2024, while Chinese mines produced the same amount. The math indicates China now consumes its entire domestic silver production internally. The export licensing system formalizes what market data already revealed. China has become a net silver importer disguised as the world's largest exporter. This discussion is for educational and analytical purposes only, and does not constitute financial advice. The notification appeared buried in routine regulatory updates between import duty adjustments and shipping documentation requirements. The language referenced strategic resource management and industrial security. Silver was classified alongside rare earth elements and lithium as materials requiring export oversight. The bureaucratic framing obscured the magnitude of what just occurred. The global silver supply chain crossed a threshold. The abundant availability that defined precious metals markets for 3 decades ended with a single administrative decree. Material scientists understand that industrial transitions follow physics rather than financial models. When a commodity shifts from surplus to constraint, the change unfolds in phases that markets consistently misprice. Laboratory breakthroughs create industrial applications. Industrial scaling creates demand curves that intersect with geological realities. Financial systems respond last, often after physical shortages become irreversible. We entered that final phase. The silver market just experienced a phase transition from which there appears to be no easy reversal. The breakthrough occurred in solid-state battery chemistry. Researchers at Samsung SDI and Toyota discovered that silver-carbon composite layers solved the dendrite formation problem that prevented lithium-ion batteries from achieving rapid charging without thermal runaway. The solution requires silver as an active electrochemical component, not merely a conductive trace element. Traditional lithium-ion batteries use liquid electrolytes that allow lithium ions to form needle-like crystals called dendrites during fast charging cycles. These dendrites pierce the separator between anode and cathode, causing short circuits and fires. Solid-state batteries eliminate liquid electrolytes but create new problems. Pure lithium metal anodes remain unstable. Graphite anodes cannot handle the ion flux required for rapid charging. Silicon anodes expand and contract too dramatically during charge cycles. The silver-carbon composite creates a stable host matrix for lithium ions. Silver atoms dissolve lithium evenly across the anode surface, preventing spike formation while maintaining conductivity. The chemistry works because silver has unique electronic properties that allow controlled ion intercalation. No other element provides the same combination of conductivity, stability, and lithium solubility. This represents a fundamental shift in how batteries consume silver. Previous applications use silver for conductivity in tiny quantities measured in milligrams. Solid-state batteries require silver as structural material measured in grams per cell. A typical electric vehicle battery pack contains thousands of individual cells. The scaling mathematics become exponential rather than linear. Samsung confirmed their first solid-state production line will begin operation in 2026. Toyota announced commercial deployment in luxury vehicles by 2027. Volkswagen, BMW, and Ford have licensed the technology through joint ventures and supplier partnerships. The transition timeline compresses as automotive companies race to solve range anxiety and charging speed limitations that prevent mass EV adoption. Current electric vehicles use approximately 30 to 50 grams of silver in power electronics and battery management systems. Internal Samsung documentation suggests solid-state batteries could require an additional 50 to 200 grams of silver per vehicle, depending on pack size and energy density requirements. Conservative estimates indicate 100 grams total silver content per electric vehicle using solid-state technology. Global automotive production reaches 90 million vehicles annually. Electric vehicle market share approached 40% in 2025 and continues expanding due to government mandates and declining battery costs. If 20% of new electric vehicles adopt solid-state batteries by 2028, the calculation becomes straightforward. 90 million vehicles times 40% EV adoption equals 36 million electric vehicles. 20% solid-state adoption equals 7.2 million vehicles. 7.2 million vehicles times 100 grams equals 720 million grams, or approximately 23 million ounces of new annual silver demand. These numbers assume conservative adoption rates and minimum silver loading. Aggressive scenarios project 50% solid-state adoption with higher silver content per vehicle. The demand curve could reach 50 to 100 million ounces annually from automotive applications alone. This volume equals the entire annual mine production of Peru, the world's second-largest silver producer. The mathematics become more complex when considering competing industrial demand. Solar panel manufacturing consumed over 200 million ounces of silver in 2025. Artificial intelligence infrastructure requires silver in semiconductor applications where conductivity determines processing speed. 5G networks demand silver in base station electronics and mobile device components. Each application treats silver as irreplaceable for performance-critical functions. Industrial silver demand now exceeds 800 million ounces annually across all applications. Mine production remains flat at approximately 830 million ounces per year despite higher prices. The deficit persists even before solid-state battery demand enters the calculation. Adding 20 to 100 million ounces of automotive demand to an already constrained market creates supply mathematics that cannot balance through price discovery alone. Supply constraints operate on geological timelines that financial markets consistently underestimate. Silver mining requires lead times of 10 to 15 years from discovery to production. Ore grades continue declining as high-grade deposits become depleted. Average silver content per ton of ore dropped from 15 ounces in 2005 to 4 ounces currently. Extracting the same amount of silver requires processing 4 times more rock, consuming proportionally more energy and water. Political factors compound geological constraints. Mexico produces 25% of global silver but recently suspended new mining permits for environmental review. Peru faces ongoing labor disputes and community opposition to mining expansion. Russia remains subject to international sanctions that complicate metal trading relationships. The 3 largest silver-producing regions face regulatory uncertainty precisely when demand acceleration requires supply expansion. Recycling cannot bridge the supply gap within relevant timeframes. Silver recovery rates remain below 20% compared to 90% for gold. The difference reflects silver's industrial dispersion across millions of electronic devices in microscopic quantities. Extracting silver from smartphones, solar panels, and circuit boards costs more than the recovered metal value. Most industrial silver becomes permanently sequestered in landfills or integrated into infrastructure. Solid-state batteries create additional recycling challenges. The silver embedded in battery anodes cannot be recovered until vehicles reach end of life approximately 15 years later. Silver consumed in 2026 remains unavailable for recycling until 2041. The automotive transition locks away substantial silver quantities for generational timeframes while immediate demand continues accelerating. Historical commodity markets provide context for how systems respond when new industrial demand collides with supply constraints. Palladium experienced similar dynamics in the early 2000s when automotive companies shifted to palladium-based catalytic converters for emission control. Initially trading around $200 per ounce, palladium reached $3,000 as supply shortages emerged. The price increase lasted several years until recycling networks developed and alternative technologies emerged. Rhodium demonstrated more extreme price volatility when automotive emission standards tightened globally. Rhodium prices fluctuated from under $1,000 to over $29,000 per ounce as industrial demand overwhelmed limited mine production. The volatility persisted for decades because rhodium has no close substitutes for catalytic converter applications. Silver faces similar dynamics with potentially greater magnitude. Solid-state battery applications cannot substitute silver with alternative materials without compromising safety and performance. The electrochemical properties that make silver effective for dendrite prevention are unique to its atomic structure. Unlike other industrial applications where engineers might accept performance trade-offs, battery safety requirements prevent substitution. Financial markets typically lag physical reality during structural transitions. Price discovery mechanisms assume supply and demand adjust smoothly through marginal changes. When industrial demand shifts discontinuously while supply remains constrained, traditional pricing models break down. The disconnect between paper trading and physical availability widens until arbitrage becomes impossible. Current silver prices reflect incremental demand growth projections based on historical patterns. The pricing mechanism has not incorporated the step function demand increase that solid-state battery deployment represents. Market participants who focus on quarterly earnings and technical chart patterns may not recognize industrial transitions that unfold over multi-year timeframes. The psychological pressure phase creates narrative confusion that obscures fundamental analysis. Financial media reports short-term price movements, while industrial publications discuss long-term technology transitions. The information gap allows contradictory interpretations to coexist. Traders see volatility and momentum, while engineers see material constraints and substitution challenges. Skeptics reasonably question whether solid-state battery technology will achieve commercial scale according to announced timelines. Historical precedent shows battery innovations often take longer than projected to reach mass production. Lithium-ion batteries required 2 decades from laboratory demonstration to automotive deployment. Solid-state batteries could face similar delays due to manufacturing complexity and cost optimization challenges. The timeline uncertainty does not eliminate the demand mathematics. If solid-state deployment occurs more gradually than projected, the silver demand increase spreads across additional years rather than disappearing. The cumulative consumption remains substantial, whether concentrated in 5 years or distributed across 10 years. Delayed implementation may actually worsen supply constraints by providing less time for mining expansion and recycling infrastructure development. Alternative battery chemistries could potentially reduce silver requirements if breakthrough innovations emerge in parallel timeframes. Sodium-ion batteries show promise for stationary storage applications, but lack energy density for automotive use. Lithium metal batteries might achieve solid-state performance without silver if dendrite formation can be controlled through other mechanisms. These alternatives remain in early research phases without clear paths to commercial viability. The physics and materials science underlying solid-state battery chemistry have already influenced real-world industrial decisions. Samsung allocated $3 billion for solid-state production facilities. Toyota restructured their battery supply chain to accommodate silver procurement requirements. Automotive companies initiated strategic partnerships with mining companies to secure long-term silver supply agreements. These commitments reflect confidence that the technology transition will proceed regardless of market sentiment or price volatility. The administrative changes in Chinese export policy suggest governmental recognition that domestic industrial silver requirements now exceed domestic production capacity. The licensing system creates prioritization mechanisms that favor domestic manufacturers over international customers. This policy framework indicates Chinese authorities view silver as strategic infrastructure material rather than tradable commodity. The convergence of technological innovation, supply constraints, and policy changes has created structural conditions that appear difficult to reverse through conventional market mechanisms. The silver market entered a phase where physical constraints may increasingly determine pricing rather than financial speculation or monetary policy. The system must adapt to new realities imposed by chemistry, geology, and industrial necessity. The investment community celebrated when silver broke through historical resistance levels last month. Technical analysts proclaimed the beginning of a new bull market cycle. Portfolio managers adjusted allocation models to reflect precious metals momentum. The financial media reported record trading volumes and institutional buying patterns. Yet while attention focused on price charts and trading algorithms, a more fundamental shift occurred in laboratories and manufacturing facilities across 3 continents. This discussion is for educational and analytical purposes only, and does not constitute financial advice. The transition happened quietly in research departments where materials scientists work with atomic-level precision rather than quarterly earnings projections. Companies that rarely appear in financial headlines made discoveries that could reshape how civilization stores and transfers energy. The implications extend far beyond precious metals markets into the foundation of industrial society itself. We crossed a threshold where chemistry began dictating economics rather than the reverse. The shift represents a phased transition in how strategic materials function within global supply chains. Previous industrial revolutions introduced new applications for existing commodities. This transformation converts a secondary industrial input into a primary structural requirement. The mathematics of supply and demand operate differently when materials become irreplaceable components of civilizational infrastructure rather than optional enhancements to existing systems. Financial markets have not yet processed the magnitude of what occurred. Price discovery mechanisms continue operating under assumptions that no longer reflect physical reality. The disconnect between paper valuations and material constraints grows wider each month as industrial deployment accelerates while mining capacity remains static. Traditional hedging strategies and risk management models break down when demand curves shift from linear growth to exponential requirements. The breakthrough occurred in energy storage chemistry, where researchers solved problems that prevented previous generation technologies from achieving commercial viability. Solid-state battery systems promised superior performance for decades, but remained trapped in laboratory environments due to fundamental materials challenges. The solutions required identifying elements that could perform multiple electrochemical functions simultaneously while maintaining stability under extreme operating conditions. Traditional lithium-ion batteries rely on liquid electrolytes that create safety hazards during rapid charging cycles. Lithium ions form crystalline structures called dendrites that grow through battery separators like metallic roots. These formations eventually pierce the barrier between positive and negative electrodes, creating short circuits that generate heat and potential fire hazards. The safety constraints force slower charging speeds and limit energy density compared to theoretical maximums. Solid-state systems eliminate liquid electrolytes but introduce new technical challenges. Pure lithium metal anodes provide high energy density but remain chemically unstable. Graphite alternatives cannot handle the ion flow rates required for rapid charging. Silicon-based solutions expand and contract dramatically during charge cycles, degrading performance over time. Each approach solved specific problems while creating others that prevented commercial deployment. The solution emerged through understanding how certain elements interact with lithium at the atomic level. Silver possesses unique electronic properties that allow controlled lithium-ion intercalation without destabilizing the electrode structure. When combined with carbon in precise nanoscale composite layers, silver creates a host matrix that dissolves lithium evenly across the anode surface. This prevents dendrite formation while maintaining the conductivity required for high-power applications. The chemistry works because silver atoms can accommodate lithium ions within their crystal lattice without significant structural deformation. The process occurs reversibly through thousands of charge cycles while maintaining electrochemical stability. Carbon provides mechanical support and additional conductivity pathways. Together, the silver-carbon composite creates an anode system that enables solid-state batteries to achieve performance levels that surpass conventional lithium-ion technology. This represents a fundamental change in how batteries consume silver. Previous applications used silver for electrical connections and circuitry in quantities measured in milligrams per device. Solid-state battery anodes require silver as an active electrochemical component in quantities measured in grams per cell. A typical electric vehicle battery pack contains thousands of individual cells, each requiring its own silver-carbon anode layer. Samsung confirmed their first commercial solid-state production facility will begin operations in 2026 with initial capacity of 50,000 battery packs annually. Toyota announced deployment in premium vehicles by 2027, with plans to scale production across their entire electric vehicle lineup. Volkswagen Group licensed the technology through joint development agreements covering their Audi, Porsche, and Bentley brands. Ford and BMW established strategic partnerships with battery manufacturers to secure access to solid-state systems for their electrification programs. The automotive transition timeline compresses as companies race to solve range anxiety and charging speed limitations that currently restrict electric vehicle adoption. Government mandates in Europe, China, and several American states require manufacturers to achieve specific electric vehicle sales percentages by 2030. Solid-state battery technology represents the most promising path to meet these requirements while maintaining vehicle performance expectations. Current electric vehicles incorporate approximately 30 to 50 grams of silver in power electronics, battery management systems, and high-voltage wiring. Internal documentation from battery manufacturers suggests solid-state systems could require an additional 50 to 200 grams of silver per vehicle, depending on battery pack size and energy density specifications. Conservative estimates indicate total silver content approaching 100 grams per electric vehicle using solid-state technology. Global automotive production reaches approximately 90 million vehicles annually across all manufacturers and vehicle types. Electric vehicle market share approached 40% in 2025 and continues expanding due to regulatory requirements and improving cost competitiveness. If 20% of new electric vehicles adopt solid-state batteries by 2028, the mathematical implications become apparent. 90 million total vehicles multiplied by 40% electric vehicle adoption equals 36 million electric vehicles annually. 20% solid-state adoption within the electric vehicle segment equals 7.2 million vehicles. 7.2 million vehicles requiring 100 grams of silver each equals 720 million grams, or approximately 23 million ounces of new annual silver demand. These calculations assume conservative adoption rates and minimum silver content requirements. Aggressive deployment scenarios project 50% solid-state adoption within 5 years as manufacturers compete on charging speed and range capabilities. Higher performance battery packs designed for luxury vehicles or commercial applications could require 200 grams or more of silver per vehicle. The potential demand range extends from 20 million ounces annually in conservative scenarios to over 100 million ounces under aggressive adoption assumptions. The magnitude becomes clearer when compared to existing silver market dynamics. 23 million ounces equals the entire annual mine production of Peru, currently the world's second largest silver producer. 100 million ounces approaches the combined output of Mexico and Peru, the two largest silver-producing nations. This new demand category would compete directly with existing industrial applications for access to limited mine production. Solar panel manufacturing already consumes over 200 million ounces of silver annually as photovoltaic installations expand globally. Artificial intelligence infrastructure requires silver in semiconductor applications, where thermal and electrical conductivity determine processing speeds. Fifth-generation wireless networks demand silver in base station electronics and mobile device components. Each application treats silver as irreplaceable for performance-critical functions where substitution would compromise system capabilities. The mathematics suggest convergence toward a structural bottleneck that traditional market mechanisms appear ill-equipped to resolve. Industrial silver demand now exceeds 800 million ounces annually, while mine production remains flat at 830 million ounces. The deficit persists before solid-state battery deployment enters commercial scale. Adding 20 to 100 million ounces of automotive demand creates supply equations that cannot balance through conventional price discovery alone. Historical precedent indicates that when new industrial applications collide with geological constraints, the resulting transitions unfold over years rather than quarters. Palladium required nearly a decade to establish new equilibrium pricing after automotive demand overwhelmed supply. Rhodium experienced persistent volatility for 2 decades because no substitute materials could replicate its catalytic properties. Silver faces similar dynamics with potentially greater magnitude due to the irreplaceable nature of its electrochemical characteristics. The investment landscape reflects growing recognition that silver has transitioned from precious metal to strategic material. Sovereign wealth funds initiated direct partnerships with mining companies to secure long-term supply agreements. Technology companies allocated billions for battery production facilities that require consistent silver availability. Automotive manufacturers restructured supply chains around materials procurement rather than just-in-time delivery models. These commitments suggest institutional confidence that the industrial transition will proceed regardless of short-term price volatility. Financial markets continue operating under assumptions that may no longer reflect physical reality. Price discovery mechanisms assume elastic supply responses to demand increases. Traditional hedging strategies presume that higher prices will eventually attract sufficient new production to restore balance. These models work effectively when dealing with marginal demand changes within established industrial patterns. They break down when breakthrough technologies create step function increases in material requirements that intersect with geological limitations. The disconnect between paper pricing and physical availability appears likely to widen as industrial deployment accelerates, while mining capacity expansion remains constrained by geological and political realities. Current silver prices reflect incremental growth projections based on historical demand patterns. The pricing mechanism has not yet incorporated the exponential demand curves that solid-state battery adoption could generate. Market participants focused on technical analysis and momentum trading may not recognize industrial transitions that unfold over multi-year timeframes. The convergence of technological innovation, supply constraints, and policy changes has created conditions that appear difficult to reverse through conventional mechanisms. Silver entered a phase where physical constraints may increasingly determine market dynamics rather than financial speculation or monetary policy. The system must adapt to new realities imposed by chemistry, geology, and industrial necessity. Physics has begun dictating economics rather than the reverse.